My name is Andy, and I will be teaching you about accounting for pensions and post-benefit retirement plans. Pension plans are very important because retired employees depend on the company for an income and other benefits in exchange for their services during their working years. Rebecca Rifkin reported that prior to 2008, a majority of non-retired Americans consistently thought that they would be able to live comfortably in retirement, but this dropped to 46% during the U.S. recession in 2008. In 2012, fewer than 4 in 10 non-retirees thought that they would have enough money to live comfortably in retirement. As you can tell, it is obvious that general economic conditions affect how Americans look at retirement. Your future is important, so I will be explaining the different types of pension plans and how they are accounted for so you can have a deeper understanding of how it affects your future retirement plans. I will be going over the defined contribution plan, which is becoming more popular, but we will be focusing on the defined benefit plan, how it is accounting for, and why it is becoming less popular. Pensions and post-retirement benefits are beneficial to everyone, and it is important to understand the different types and how companies account for these. To begin, we know that a pension plan is an arrangement by an employer provides payments and benefits to employees after they retire for the services that they provided while employed. The employer is the company sponsoring the pension plans and incurs the costs and makes the contributions to the fund. The pension fund or plan receives the contributions and then they make the benefit payments to the retired employees. That is a general accounting for both the pension plans. First, let's look at the less complicated defined contribution plan. In this plan, the employer contributes a defined amount to the pension trust each period based on factors in their calculations such as age and length of service. One downfall is that there are no promises regarding the size of the benefits received by the retiree, so there is risk for the employee. The accounting for these contribution plans is straightforward. The company just takes out of cash the defined contribution amount that they promise and increases their pension expense by that same amount. Now, we'll move on to the defined benefit plans. One difference is that the amounts of the benefits are known by the retiree, and this is important. The risk is with the employer because they are completely responsible for contributing enough to meet the cost of the defined benefits. The amount of this obligation is measured by the present value of vested and non-vested benefits using future salary levels. Vested benefits are the ones that employees are entitled to even if they quit. You can see how it's becoming a bit more complicated. Some of the complexities that arise are from calculations performed by actuaries because they're based on assumptions. These include life expectancy, rates of return, and inflation or salary expectations. This is easy to tell how the accounting for defined benefit plans is much more complicated because it depends on future liabilities and expenses. In the actual accounting for the defined benefit plan, the company uses pension worksheets to illustrate the computation of their annual pension expense, cash flow, and their pension asset or liability account. For now, we'll be focusing on the 5 components of pension expense that the employee incurs. These include service and interest costs that increase the expense account, the expected return from assets of the fund in a year that decreases the expense, amortization of unrecognized prior service costs and net gains or losses, and these can increase or decrease the expense account depending on whether there are pension plan amendments or changes in fair values of the plan assets. An understanding of the defined benefit plan and the 5 main expenses that the employer has to account for is necessary when looking at its many problems. Lastly, we get to look at some of the issues and why companies are switching their retirement schemes to the defined contribution plans. They're shifting from traditional defined benefit plans to more modern defined contribution plans. This is explained by the inaccurate estimates or actuarial assumptions that are used in the defined benefit plans because they're based off of future value. In an article by Troy Adkins, he stated that many reasons why these plans can have considerable problems. One is that it is impossible to know how long an employee will work for an organization, and another is how long they will live after they retire. An example of how defined benefit plans could go awry is when the U.S. Airways Incorporation filed for bankruptcy in 2003. Bloomberg Business described the crisis that the pilots' pension plans were barely funded and actually described as a sinkhole of unfunded liabilities. Because of these issues, pensions are now mandated by different groups and government agencies to ensure that retirees will receive some type of funding in case the company's pension benefit obligation is underfunded. With the many complications and risk of not being able to fund the pension benefit obligation, it makes sense that more companies are choosing the defined contribution plan and lessen their risk of not meeting the funds promised. To review, defined benefit plans have specific parts of the pension expense, such as service and interest costs, returns, and amortization, and the amounts of the benefits are known by the retiree, but the employer takes full risk of being able to meet the contributions. The defined contribution plans are becoming more popular because the company meets the contributions of the employees and they avoid complicated accounting methods. It is largely encouraged by economists and government agencies that employees should get started right away with a personal savings strategy to ensure an adequate nest egg at your retirement. Thank you for listening and taking the time to learn about the accounting for pension and benefit obligations.